Most of us today believe that passive investing is much better than active investing. I am also in that camp. For people who do not know the markets, I suggest you do passive investment and not get into active fund management. Also, what do I say? Don't invest in active funds. This is because active funds have a higher cost ratio. But there are cases when you can follow active investors with your money and you can do it directly instead of going through a fund. Let's take a look. Welcome back to Berich. One of the reasons why I suggest that one should not do active funds is because the mood of the mob decides what an active fund manager can do. The fund manager is not truly independent as we think he is. This is because when the crowd gets nervous, they start to pull out money, and when they pull out money, then the mutual fund manager is forced to sell and is unable to hold his positions, even though he would like to hold on to his positions. Markets can be irrational longer than we can remain solvent, said John Maynard Keynes, a great quality investor. What he meant is, if there is a big drop in the market tomorrow, most of us would like to pull out our money. In the last 3 years, the Nifty and the Sensex have not given spectacular returns. Twice or thrice, they have gone down 25% and it has come back to where it is. Cheap money at low interest rates has meant that a lot of money has gravitated towards stock and there is an inflation in asset prices. But the asset prices are already so inflated that you cannot expect them to keep going up forever. In such circumstances, when the market crashes, people tend to pull out money out of active funds. This is where we talk about quality investors. Quality investors are investors who do not have any pressure of time and they are not answerable to any fund manager or any person who has invested money. They invest their own money or invest money of investors through long-term holdings, where the investor is not in a position to withdraw his money at the first sign of danger. When such a quality investor is allowed to work freely, he is able to pick bets and buy companies which are deeply profitable but very unpopular with the markets today. They can buy and hold on to the market forever, hold on to that stock forever and wait patiently for it to turn around and make huge profits. Buffett wanted to buy Coca-Cola for a long time. The price was unfeasible. He waited for the right time and bought Coca-Cola and has held on to Coca-Cola forever. There is no pressure from his investors that he has to sell. Same thing with Apple. It was a deeply unpopular buy but turned out very profitable in the long term. He has also made mistakes in terms of buying IBM and Wall Street. Not every decision of a quality investor is correct, but he has the space and time to rectify his mistakes and wait patiently for his bets to fructify. This luxury is not there for mutual fund managers, and this is why I say avoid active mutual funds. Thank you for watching Berich. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification. If you use Kindle, you can buy the book using the Kindle link given below. If you want a hard copy, send a message to the WhatsApp number given below and my team would get in touch with you. At the very end, if you want to get in touch with me, please send a mail to berichenglish@gmail.com. I am grateful for your support of Berich.